2005 and 2006 that the real estate market was completely overvalued. There was fraud going on when it came to lending. You had strippers that owned 10 to 12 condos in Florida with no tenants, and real estate agents flipping homes left and right. So that was a very interesting situation. And when you have an overlay on top of that, you had banks that were taking these mortgages of all these empty homes and then securitizing them with other products like toxic loans and derivatives, and packaging them into CDOs and CDOs squared, and then using banks to sell them to insurance companies and pensions and other financial institutions. So what ended up happening was that the banks oftentimes kept the residual interest or the bottom part of the securitizations or the top part on their balance sheet. Didn't matter. They all fell. And what ended up happening was nobody knew how to value these assets. So it was much worse than what we're seeing today because no one knew how to value these assets. They just zeroed the assets. So you saw a free fall in the entire banking sector. And it was so bad that you actually saw $200 withdrawal ATM limits on banks. Like, you think today's bad? Like, you couldn't even take out more than $200 from an ATM.
That was
So
insane.
so I
That
think
was
that,
insane.
there are a few different catalysts. There were the two Bear Stearns hedge funds, which were the first signed to me in the summer in July of 2007. BNP Paribas in Europe, for the Europeans here, was also warning that you may not be able to withdraw money from three of its funds around the same time. And there was a British bank that you guys probably all know, you Brits in the crowd, Northern Rock, was also seeking emergency funding from the Bank of England back in 2007. And then, despite these warning signs, there were few investors that that were incredulous about what was going to happen. People were all kind of predicting it, and that's how you got the Big Short. And it wasn't just one guy; it was several funds. When I was at Goldman, we were also betting against this, and there were several funds that were betting against subprime. Subprime was essentially no doc lending and low FICO score lending to people who were non W-2, didn't were lied about their income, and all that led to the September 2008 collapse of Lehman Brothers, which was the biggest bankruptcy in the U.S. ever. I was actually one of the biggest holders.
Before you continue, Jay, I want to ask a question about something you mentioned, and then I'll let you continue with the story. Just quickly, Nomura forecasts a 25 basis point Fed rate cut. So I just wanted to
Really,
mention
that is very interesting. Nomura tends to have a contrarian view when it comes to rates, but I'm very happy you brought that up. So they predict, is it only for March?
Yeah, I'm just having a look now. It's on Benzinga tweeted it. I'll try to get
Okay.
him back on stage. But yeah, and a QT held
And
in
for
March.
QT to stop as well.
Yeah,
Wow.
just read it now.
Yeah, I'd take
would take
the other side of that.
That is that.
It's probably
But
going to be a 25 bips hike.
I would be inclined
But what-
to agree with Nomura.
So you think that
who
QT
said that?
should? I think, if the banking crisis gets just terrible, I mean, no one can predict the future. Like, if things just get a lot worse, no one here has a crystal ball. But I think that Nomura is kind of leaning here of saying that they're going to stop QT and cut rates by 25 basis points. But hey, I can definitely be wrong. Did we want to go back to? Go ahead.
The Fed would lose credibility on that. I mean, that's not they've still got to fight inflation, and they've got to be shown to be fighting inflation.
But
They
I
would
think
lose
I
credibility for a
uncovered
cut.
something.
Yeah,
If the situation is,
I think I uncovered
Go ahead.
something that
Who
shows
disagrees?
that they're not working in our favor. Suleiman and Douglas have been on here when I was here, and I don't remember if you were here, Jay, but I mentioned it before. I follow a site called Trueflation. It does like a real time
Yeah, it's been
inflation
declining.
rate.
I like that
chain.
site.
Yeah, and they're typically 1% off for within 1% of what the numbers come in. In this past month, they're 2%. But now you just mentioned that the basket changed. And I kept saying on this call, even yesterday, I said, unless they changed the basket or did something, I don't understand why it's off this month. And now we see they did change the basket, and they actually reported higher inflation than what was if they would have used the original basket, more than likely. Is that so they could be aggressive with interest rate hikes? Like, do you see what I mean? I don't know what your thoughts are on that, but I'd be curious. If you follow that site, you've seen like they're always within a point of difference for months.
Just who disagreed? Was it you, MG, that agreed with Nomura?
I did no. I agreed in large. I don't think that I don't expect a cut. I do expect a pause, and I do expect the
But
Fed to pause Q2.
for them to expect a cut? Sorry to interrupt. For them to expect a cut, could things be worse than we think? Maybe they know
Absolutely.
something we don't. And then, because if that's the case, then obviously, inflation, as Jay you mentioned a few times, inflation is less and less of a concern. So my question
Absolutely.
is, it's more like determining how bad things are. And I read a few messages before of people that are usually conservative and level-headed, and they don't like to spread fear. And they messaged me that they told me not to reveal the identity, but they're like, Mario, it seems a lot worse. And I think I read some of the messages earlier. I tweeted some of the messages as well. So I'm just worried that the fear is more than we think. And a bigger bank run to regional banks could come in.
It could happen. I mean,
and then you go
it's
back
not
to the whole
out of
discussion,
the realm of possibility.
the story of, but
And
and
it's also not
for
necessarily-
Silvergate to implode this quickly, not Silvergate, sorry, Silicon Valley Bank to implode this quickly, the speed of which this happened. I know we try to put the blame on Peter Thiel, and you guys are better experienced than I, but it just scares me of how fast things imploded.
Absolutely. I think that it doesn't necessarily have to be something that they know, and they're looking at the data, and the data looks far worse. I think that just the mere fact of uncertainty would lead people to just pause and to hike, simply because I think that even in the case of Silicon Valley Bank, I do think that another explanation could be that with regards to why the executives didn't move or anything like that is because they expected, frankly, that they'd be able to raise equity financing. They did have a $500 million commitment by a serious private equity player, General Atlantic. And so, Jay probably agrees with on this. If you had a $500 million commitment with GA and you were trying to raise $2.2 billion, you probably thought you had a pretty good shot of completing that deal. It turns out that, the rest of the investment community kind of poo-pooed that. Then on top of that, you had, a run on the bank in terms of deposits kind of leaving the bank at record rates. And so that led to this sort of where we are. And so the Fed looking at that might be sitting there going, wow, confidence maybe is highly uncertain. This wasn't a situation of insolvency, but, if people are that kind of, lacking that trust and they need a lot of reassurance in order to make sure that their deposits stay in banks, do we want to be hiking in the face of that? I got to think that, that uncertainty alone would give some members to pause. And then on top of that, if this is a deflationary event, because effectively banks are going to stop lending because either, there's more requirements, there's less deposits, or deposit rates go up and net interest margin goes down. All those reasons are reasons for banks to stop lending. Those are going to be deflationary forces, and for that, and those would ultimately lead to some sort of pivot, pause, or potentially a reversal. Jay, do you have a
I think
view?
that the uncertainty, that no one can really challenge the fact that there is uncertainty, and then if over the next month we see this continue, then I think a pause is reasonable. I think a cut is still a little bit of a stretch, because then you kind of go to the perception that the Fed is not credible, and it would make people, I think, more scared. If the Fed were to cut, okay, what's really going on? If the Fed is cutting, what could be wrong with the economy? But taking the devil's advocate and taking the other side to this view, I would say that if we see a massive deflationary shock, which I don't expect, like by massive, I mean like several banks going under, in that case, it would actually make sense, because the inflation risk would be completely off the table. But, if one or, if two to five banks, are gone, and a bunch of others have to raise equity, and then, 3-4 weeks go by and we're fine, and we're in a 50 basis point range in equities again, and bonds have yields have widened again, then I think, you're probably either a pause, or 25 bips in May.
Do you really think the bond market's going to be strong though? Because you're basically treating different bond buyers differently, and a lot of experts, and myself included, think you're not going to have as much international buying of
So I think a lot of
bonds.
people have said that, but I think if you actually go into the financial statements and the earnings calls of the Japanese banks, and the Japanese banks are one of the biggest buyers of U.S. Treasuries, I think what they're saying is that the only two reasons they're not buying bonds. In fact, U.S. bonds are probably the best asset to own right now on the planet. The reason why they're not buying them right now is they don't have insight into the Fed, just like we don't, like when rates are going to peak, right? They don't want to make the same mistake that SIVB did. That doesn't reflect on the relationship with the U.S. It doesn't reflect on the creditworthiness of the U.S. It reflects on the fact that when interest rates go up, bond prices go down. It's a very rational form of thinking. The second reason why I think foreign institutions are not buying as much as they were in prior years. If you look at a 10-year chart, it's going straight up. But if you look at the last 12 months, the reason why countries aren't like China is that China has the massive real estate problem, and they need to fund it with reserves. And same thing with Japan. They had a huge problem during the Chinese shutdown. They were going through a recession while the U.S. was growing, and they needed to support the Japanese yen. They were buying 62% of their own bonds to stimulate their own economy. So those are kind of exogenous reasons. And the third reason is that FX volatility takes away the profit margin of buying U.S. bonds. You remember the Japanese yen was moving like 30-40% a month, which is insane. Like, you haven't seen those types of moves in 20 years. As a result, the cost of options to hedge the currency were so high, it was taking a lot of the gain away from the yield. So I actually think that the Japanese are going to come back to buy treasuries in the second half of this year. And I think that more than the foreigners actually posted, there's actually a graph that shows that if you include the institutions and not the governments, in the last quarter, it actually inflected a little bit higher. And going forward, I actually think that the domestic buying, right, money moving out of banks and into treasuries in the U.S. is going to more than offset, that small decline in foreign buying. But you make a valid point. In the last 12 months, there's been some softness,
Dude.
but the bond yields in the last 2 days have gone in like the most I've seen since 2008 in a 2-day period.
Do you know if international banks buy our long-term treasuries?
They do.
They
Like,
do.
could this affect them as well?
They do, and they have to. So as long as, something like 75 to 80% of the world trade is in dollars, any party overseas that receives dollars has to put that to work somewhere. They can either buy things, physical things, like, commodities and whatnot. Like Jay said, if they need to sort of like invest in their own internal, construction, or the, Belt and Road project, if they're building real things. Otherwise, they have no choice but eventually to find its way into the U.S. Financial system. And treasuries are usually the security of choice for folks internationally.
Yeah, I agree 100% on
as long as U.S.
point.
trade, right? So as long as trade persists in dollars, people have to buy bonds.
So what's the risk of a global banking contagion? Because they're going to be international banks kind of in the same situation.
Well, the international banks are in the same situation because they own European bonds where the losses are even worse. Actually, U.S. bonds actually look more attractive than bonds outside of the U.S. Like, would you rather buy a Japanese bond that's kind of pegged at 50 basis points? Or would you rather buy a U.S. T-bill at 5%? Even FX adjusted, you're making a fortune. So listen, I don't know what the answer to the question is, but I do think the European banking system is weaker than people may see right now. And who knows what's going to happen to banks overseas. But what I will say is that in a flight to safety, when risk assets sell off, even in 2011, when the U.S. debt rating was downgraded, and it was 3 years after 2008 and people were scared, bonds actually were bought. Bond yields actually came in.
Jay, do you see anything with
Jason, your mic is really bad, and And while you're fixing your mic, I'll pretend that Brad is not putting his hand up, so I can be selfish and ask a question to Jay, and then we'll go to Brad and Jason. My question, Jay, is in a way, in hindsight, we're talking about all the problems that were boiling back then. But back then, anyone that talked about these issues was laughed at, and obviously the movie The Big Short, articulates that really well. My question is, we've had you and Wahid talk about the sovereign debt and the amount of leverage there is in the economy, in the financial system. Is there something that everyone is ignoring that could be a catalyst for what we saw in '08? Again, it's impossible to know for sure, of course. Otherwise, the market would factor it in.
Well, commercial
But
real estate,
just
commercial
playing
real
devil's
estate is
advocate
the
here.
biggest issue, and I would, I think it's a little bit different. It's actually a lot different than 2008 because commercial real estate, the private equity sponsors that own commercial real estate are not people. They are funds, private equity funds that are invested in.
Was it my end or did Jay drop out?
No, he dropped out.
Oh, I thought the space glitched. Whew. Don't want it to crash again. I get sick of this crashing. We'll go to Jay. I'm not sure if you're back with us. Glitched on your end. But would love maybe MG while waiting for Jay to come in. Do you want to give us more thoughts, you and Douglas? I'd love your thoughts on this particular question, especially
Sure.
commercial real estate. Douglas, you want to go first?
Yeah. Sorry, I just got off a call and heard Douglas. I'd love your opinion on this question.
Yeah. So the question I asked is we talk. Every financial crisis is different than another.
Yeah.
Than the last one. So I'm talking about the '08 crisis. We saw the all these financial instruments that no one talked about back then, but obviously when everything imploded, everyone started talking about it. So I'm wondering whether if there's something now with the amount of leverage the financial markets have around the world, is there something that we don't know yet that could lead to a repeat of what happened in '08? And there's also the narrative since '08 that every year is just we're just putting a band-aid. We're putting a band-aid. It's inevitable with all the printing that we're going to see a worse financial crisis. Is there something we're missing that could spark what we saw in '08 that no one's talking about?
If I knew what that was, I would tell none of you and
no one.
Go make a position on that. I get the question though. I mean that's always that's what people are actively looking for, is what's going to create a black swan event cause the other shoe to drop, and we're now falling pretty hard, and we got ourselves another great recession, if not worse, on our hands. There always could be something looming out there. In this case, I think we saw what it was, at least right now in the context of Silicon Valley Bank. Poor risk management decisions by management when it came to those treasuries. Again, we mentioned this. Yeah, I mentioned this yesterday. You got to somewhat chuckle at the irony that the safest investment on earth is the underlying asset causing this situation to take place. Not credit default swaps on packaged subprime mortgages, and these rather these things you've never heard about until such time as a movie like The Big Short comes out, or for the masses to truly understand. I think this is about a lot about the way we think about banking from a historical standpoint, and how that doesn't quite match up to the way that capitalism and business works today. A lot of things over the course of the last few days in this space is this constant, I read in this book that was written, however many years ago, 50 years ago to 60, 70 plus years ago. That was a very, very different world than where we are right now. And I feel like we constantly find ourselves innovating and for lack of a better word, making up a word, financializing things, the financialization of things that, outpaces the regulation, the rules, and the rails that we've put into place. I mean, crypto is a great example. It's now folded into this. What's wild here is, for the first time, we have a crisis, and crypto is being brought up alongside of it, not deliberately trying to bring the conversation back to crypto, but good Lord, 2008, Can you imagine like saying like, yeah, and then in the future, you know, decentralized finance will be paired with traditional finance, and we'll have all kinds of, you know, crazy shit taking place. So for anyone who knows what's looming out there in terms of some